So Todd, thank you again. We're gonna have you kick in for 404, and I won't steal your thunder. So let's rock and roll.
Sounds good. Thank you, Phil. Um, Thank you again for everybody's time being on this today. Let's do kind of a brief recap of what we covered and how today's session will complement and stack on top of what we've already spoken about. So in session one, we talked about some sales ideas, how to start conversations regarding income protection. We talked about the moving parts within a disability policy, how premiums are derived, how underwriting works, so on and so forth. Session two, we talked about kind of the two different individual markets of white collar and medical and middle income and blue collar. Then in the last session, we talked about kind of the different end of personal income protection, which is the business market. So we talked about buy sell, we talked about business overhead expense, key person, and loan indemnification. Well, it all kind of comes together today because we are, as you see on your screen, we're going to talk about Lloyd's of London today. And Lloyd's does anything and everything that the traditional carriers simply can't or won't do. And what I will tell you is get ready to have your mind blown because some of the stuff they do is amazing. The numbers that they come up with are unbelievable. And they, like I said, they knock it out of the park. I do have a pretty good history with this because I actually spent 6 years as an RVP at one of the cover holders for Lloyd's, and we'll talk more about what is a cover holder, so on and so forth. So I've got a good history with this. I know how it operates, how it functions, and it's nothing to be scared of. So most importantly, first of all, when we talk about, and by the way, if you guys have questions during the session, it's actually probably easier to jump in and ask those questions as we go versus waiting until the end. We'll address those as we move through this. Then we'll also have a little Q&A at the end as well. To talk about Lloyd's, we kind of need to have just a brief history on Lloyd's and how this actually plays out. If you guys are aware, Lloyd's is where insurance started at, and they can date it back to 1688, and that's a rough number. Okay, it started all at Lloyd's Coffee House, which a coffee house back then is not like a Starbucks is today. Okay, coffee was a commodity for the very, very wealthy. And what they were finding was Mr. Lloyd had his coffee house. It was near the docks. And what he was finding was the ship owners were coming down to the docks every day to see if their ships had returned to port. Well, the entrepreneur that he was, he realized that if he provided them space to visit, guess what they would likely do? Purchase more coffee. And this is how insurance got started. These ship owners realized that if Phil and I each have a ship and my ship goes down, I can't afford to replace the entire cost for that. So we pooled together and say, hey, if my ship goes down, I'll pay for 50% of it. You pay for 50% of it. If your ship happens to go down, I'll pay for 50% of it, and you could pay for 50% of it. Sounds like a great idea. That's how insurance got started. We jump ahead 200 years to 1890, and they call it the Act of Parliament, the Lloyd's Act of Parliament. And this was when Lloyd's wanted to get into the life insurance world. Up to this point in time, they had been mostly maritime risk. Parliament actually jumped in and said, hold on, absolutely not. We are not going to let you do this. Up to this point in time, you guys have been maritime, and that is temporary coverage. Life insurance at that point in time in history was only permanent insurance. There was no such thing as term insurance at that juncture in our world. They said because Lloyd's is temporary coverage and life insurance is permanent coverage, and you have such a head start on everybody in the insurance world, you would monopolize. We are not going to let you sell life insurance, and deemed Lloyd's to be temporary insurance. Lloyd's had to go back to Parliament and say, well, we need you to clarify what is temporary insurance. Temporary insurance is to last no more than 5 years. Guess what? That law is still in effect today. So every policy that is sold through Lloyd's has what they refer to as a policy term. That policy term can go up to 5 years, or it can go literally one day all the way up to 5 years. And when you hit the end of your policy term, the client must renew. And in our world, they would also get new attained age. Okay. So think of it as a little bit like age banding. All right. Your rates are good from 30. If you took your policy out at age 30, they're good from 30 to 35. And then you get new rates from 35 to 40. And then new rates from 40 to 45, so on and so forth. Then we jump into, we get to 1941. And this is when they were very scared actually because we had thought as Americans that that London was going to be speaking German very, very soon. And it was a very big deal. And they didn't know what would happen to that risk if Germany took over and seized those funds and so on and so forth. So the United States created what they called the Central Fund. And this is still in effect today. And this is to make sure that every risk that is being taken on within the United States has funds that are available to pay it out should a claim, no matter what it happens to be made. This could be because of a disability claim. This could be because of a commercial claim, so on and so forth. All right. So every dollar that is paid in premium actually goes to the central fund. It sits there for 3 years, and then it goes across the pond to London. And that's when they finally start realizing their money. So it's just basically a safety net, right? So we don't have to worry about claims never being able to be paid. The other thing that I would have you keep in mind is that Lloyd's is surplus lines coverage. All right. Every policy and everything that we've talked about up to today has been what we would call a traditional carrier, traditional lines type of insurance. This is outside of that realm. Now, it's not to say that it's not regulated because it is highly regulated, but we're not subject to the same rules that are being played within the traditional carrier space. Okay. So what I will tell you is Lloyd's can do anything. They we joke, but it's actually not a joke. Uh, Peterson International Underwriters, they're the biggest cover holder for Lloyd's. Kind of one of their internal mottos is there's no such bad risk, there's only bad premium. Okay. They can do anything if you're willing to pay for it. All right. And they get to make stuff up as they go. Again, it's not that it's not regulated, it's just that they can literally tweak a policy for whatever a client has going on in their lives and be able to make an offer each and every time that's out there. It's really, really specialized. One of
Um,
the things, yeah, jump in.
just real quick question, is that so when you talk surplus lines and stuff like that, I remember back in the day there would be people who would insure body parts. So,
Yep,
Jennifer Lopez with some part of her body, some people would do like their leg
yep,
and stuff like that. Is that what you mean
yep.
by surplus lines or
It's just outside of the normal realm of traditional insurance.
okay,
So part of the rules of surplus lines, Phil, is that we are from a disability perspective, we can't go to them for first dollar coverage if a traditional carrier would take on that risk. So
gotcha.
as an example, if I try to go to Lloyd's right now and get a disability policy on myself, the first thing they're going to say is, well, you work in insurance. You're currently not making $8 gazillion and your net worth isn't, 20 million plus. Why are you coming to us? Right? Well, I just thought that I really wanted to use your coverage. They're going to say, no, thank you. We can't take you. You have to go try. Okay. So they will walk away from the business.
Wow.
The reasons that and we'll talk about this a little bit more, but the reasons that we would use surplus lines would be occupation, which we'll visit about more. We go to them for upper ages. All right. We go to them for health history, and then we go to them because they're this is the one that they really like because their net worth and income is so high. Right. We get to points where the traditional carriers just go, sorry, we can't help you anymore.
Yep.
Now we look into the surplus lines coverage to supplement what we've got going on through a traditional carrier, or they can play first dollar when a traditional carrier says, sorry, we can't help you at all.
Gotcha. Okay. Okay. Just
One of
curious.
the big things,
I
go
was
ahead.
I was just starting to think about famous people and which appendages I need to go get them covered and stuff like that. So I got excited, but
Yep.
sounds like it's
So
not the case.
they used to do that. They used to do a lot of that. And actually what they've realized now is that for somebody who wants to, insure their voice or, whatever it is, it's easier for them to just insure the entire person than it is
Gotcha.
for one particular thing,
Because it can be
so.
really subjective, right?
Right. Yep. Yep. Exactly. Exactly. One of the things that I'll address is so again, highly regulated, not playing by the same rules. We refer to it as the address game. The address game basically says, you know, this is worldwide coverage. All right. And a client does not have to be a US citizen to obtain Lloyd's coverage, nor do they need to be living within the United States. And but not all states like all of the products that they have to offer. So, as an example, they don't like Nebraska, where I live, does not like the life insurance policy that um, that they have to offer. However, I could use the address of a relative in another state where it is approved. Okay, it doesn't have to be my address, it just needs to be an address. They don't care, they don't look, they don't check. It's that simple. It's not that it's not regulated, it's just we don't have to play by the same set of rules. So it's unique. I promise you, we're not going to get you in any trouble. And even though this is, so I know this question typically comes up too. Even though this is surplus lines coverage, you do not have to have a surplus lines license. You only need your life and health license, and you are allowed to write every product that we are talking about today. So no additional coverage unless you want to write somebody in New York, then it takes an extra license there because New York is New York. So always fun there. Lloyd's also has what they refer to as syndicates. All right. So what we have to keep in mind is Lloyd's is not a business. Lloyd's is a marketplace. It is like the New York Stock Exchange. All right. Um, and within Lloyd's, we have syndicates. Syndicates are independent writing companies that make up this Lloyd's marketplace for us. Okay. So what I will tell you is Lloyd's isn't just Lloyd's. All right. So as an example, if Phil wanted to get a quote from me for an emeritus policy or a principal policy or a policy through standard, and he gives me the exact criteria, and I set up the illustration, and I provide him with all of those numbers, he can go to any disability GA across the country and say, here are the parameters for this client, set up the illustration. And it's going to be the exact same premium each and every time. That's not the case with Lloyd's. It all depends upon who is the cover holder. Okay, um, which of their we'll talk about cover holders in a minute, but which cover holder do we send the policy through, and which syndicates does that particular cover holder end up using? Okay, so we take them, client A, and we say, hey, here's the criteria for this client, and syndicate number one sends us a premium, and it's this much. And we send it to syndicate two, and they come back and it's a premium, the exact same client, it's a completely different premium and completely different policy parameters. So they view risk a little bit differently. And sometimes we see that those things flip flop. So we actually use two different Lloyd's cover holders to make sure that we're getting the best offer each and every time for you. There are roughly 94 syndicates that make up the Lloyd's marketplace. All right. So 94 different underwriting companies that are taking on the risk on behalf of Lloyd's. This is a photo from the new Lloyd's building. Now, what's the one thing that you don't see here? You don't see any walls, right? It's all open air. That's originally how they did business. Okay, we don't have a ton of time to get into it today, but they're very nostalgic. They keep doing the same things over and over again. So even though they built their new building, it is still open air. There's no true office space. There's no closed walls. It's a very, very unique place. Here is a copy of an underwriting slip. All right, and it's a little bit difficult to see, but underneath the red box, you will see that it was dated April 12th, and it was insured for a million pounds. And what we find is that underneath this, all right, those are the amounts of insurance that they are willing to cover with the underwriter's name by it. This is how the term underwriter came to be. You write your name under the risk. Make sense? Little little history lesson there. Anybody want to take a stab as to what this particular risk happened to be?
I think I know.
Fire away, Phil.
Is it the Titanic?
It is the Titanic. Great job. Yep. This was not a good risk for Lloyd's. Okay, that was a one and done, but it paid. You know what I mean? That's why you insure the risk because you don't know. Even though it was the unsinkable ship, here we are. So again, you write. This is how the term underwriter came to be. You write your name under the risk that you are insuring. All right, moving forward here to maintain our time. Let's talk about cover holders. These are our avenues to get to Lloyd's. Again, this is a marketplace, all right? So you can't just say, call Lloyd's and say, I want to write a policy with you. They're going to go, yeah, no, you can't do that, right? You can't go directly to the New York Stock Exchange and buy stock. It doesn't work that way. You have to find a broker to get there. Well, through Lloyd's, you have to find a cover holder to get there. All of the cover holders within the United States are meant to look, act, feel like a traditional carrier, all right? But Lloyd's is taking on 100% of the risk. So these cover holders are technically managing general underwriters on behalf of Lloyd's. They are not retaining any of the risk. All of these carriers or these cover holders will do contracting, they do all of the underwriting, and they also pay all of the commissions. Now they will use a third-party claims vendor, so they do not do their own claims. But these claims vendors they're really good, and in fact, when they get into tricky claims, all of the traditional carriers end up using these same claims vendors anyway. So these guys are literally the experts that are out there. So the question is, who are the cover holders? Well, we talked about this briefly. Peterson International Underwriters, known as PIU, they are based out of California. They are the largest and longest tenured cover holder within the United States. They're fantastic to work with. They get things done quickly, and we really like what they have to offer. Now, that being said, again, they don't always have the cheapest premium, and so again, that's why we use a couple of them. The other one that we use is International Disability Underwriters, or IDU. They are based out of Florida. IDU does some things that are a little bit different than what Peterson happens to do, but one of their core focuses actually happens to be with impaired risk. So when we have medical declines, they're really good and put out really nice offers for impaired risk clients. And then probably the third biggest one out there is called ERA. They're owned by Acrisure. I know that there's been a ton of mergers and acquisitions out in the insurance world over the last several years. They happen to be one of them. We don't currently use them. And then the other one is that's a known entity out there. They're called Hanley. They're owned by BB&T Bank, which also, if you guys have been in the industry for a while, they also own Crump, right? So anyway, we use the top two. Those happen to be the biggest and most well known. So here's our list of the carriers again, right? Our grid. And as you can see, they're pretty much doing everything out there. All right. They don't necessarily do student loan writers and things like that. That's not really their forte, but they will tackle not only personal disability insurance, they can do all of the business insurance, and they can do even some unique things that we've never even thought about or think about on a daily basis. So again, if we know what the problem happens to be and what the client's needs are, we take that to them and they come up with the solution for us, which is really cool. We talked a little bit about this, but again, when, where, and why do we use Lloyd's? Okay. Again, we want to use Lloyd's in the event that the traditional carrier simply can't or won't. The major space that they want to play in, as we talked about, is excess DI. Okay, these are high income earners or people who have very high net worth. All right, who doesn't want the whale, right? That's at the end of the day, if you've got clients that are making millions of dollars a year, we need to insure them. However, what we find again, remember, is that traditional carriers will offer between $30,000 and $35,000 a month of benefit, and then they're done. They've hit their issue and participation limits. Reinsurance does not allow them to offer anything further. Well, what do we do? So if you've got a client that's making $1 million, all right, and they look at 65% as the kind of the base for income replacement. A client would need $56,000 a month, all right, to insure 65% of their income. And if we've got a policy through Principal or Emeritus or Standard, and we have $30,000 from them, we've got a $26,000 per month shortfall. That's a problem. Now, it's a first world problem, but it's a problem nonetheless. And what we would do is we would put in that first $30,000 with that traditional carrier, and then we would go stack Lloyd's on top of that. All right. So this supplements and it complements what we have available to us through the traditional carriers. So my question is, and we'll open this up, okay? How much do you think they're willing to offer per month in addition to what the traditional carriers have to offer? I want to open it up and get some of your thoughts and see what you guys think. How much do you think they're willing to offer after the traditional carriers?
Maybe one of the other Phil Reshes will answer.
Or throw it in the chat box.
Yeah. Come on, guys.
Do you think it'd be $50,000 a month? Traditional carriers only go to 30.
The one of the other Phil Reshes said 70%.
70%. In some scenarios, they will go to 70% if traditional carrier coverage is taxable or they've got a taxable group plan. But how much dollar replacement do you think that they are willing to go? An additional 50,000? Additional 75,000? Actually, they are willing to offer up to and including $250,000 a month above and beyond what the traditional carriers would offer you. Okay. So when we think
Yeah.
about that, that's an income of at least $5 million. That's not a bad offering right there. Okay. So numbers do not bother them. All right. So the income can never be too high. That's what it comes down to. The second reason that we go to them is because of age. Traditional carriers typically offer to age 60. Emeritus will offer through age 64. However, Lloyd's will offer individual policies all the way through age 75. All right. What about impaired risk? That's another reason that we go to them. We've got the client that's a medical decline for whatever reason. Maybe they're type 1 diabetic. Maybe they've got cancer history. Maybe they're just a little bit too heavy for their height. Whatever it might be, we can jump in and take an offer to them. They will offer just about any particular impaired risk situation, medical history there, except for long COVID. There is not enough history with long COVID and the long-term effects of that to know where they stand for that risk. So if a client, if you tell us that a client has long COVID, that's about the only time that they will say no, and that is not a word that they like to say very often. So that's one reason to go to them. We can get offers on 99+% of the cases that we take to them. Then we talk to them about occupations. Not every traditional carrier likes every occupation that our clients have. So here are some things that, and this is just a small list of them. Pilots, that's a big one. If you bring to me a pilot, I'm going to tell you immediately we're going to have to go to Lloyd's with it because no traditional carrier wants them. We get calls about offshore oil rig workers. Traditional carriers say if you don't come home every night, we don't want you. Well, they don't come back to shore every night, so we're in that world. Pro athletes, okay, actors, tattoo artists. There are all sorts of occupations that are out there that traditional carriers don't want to take. We would be able to, because they say no, we would be able to go get them first dollar coverage through our Lloyd's outlets. Questions or thoughts about this? I've got an example that I want to show you guys as to how this can play out too. Pretty powerful.
So, a question for you, like, because you put pilots there, I know with life insurance, you have a pilot who is a private pilot, maybe not enough hours, and they're gonna get the aviation flat extra.
Mhm.
Is there something Lloyd's can do with pilots from that standpoint that would negate the flat extras and stuff like that?
So yes, we can do that. And in fact, I'll talk about that on my very last slide, Phil.
Oh,
Uh,
sorry.
no, no,
Getting
100%.
excited.
You are on the right track there. But they will offer disability insurance for pilots. So whether they are a commercial pilot or they are, if they're earning a wage because they're piloting, we've got a policy built specifically for pilots. So Um, it comes up more often than you may happen to imagine. But I will bring up how to get around the flat extra. Here's an example of their bread and butter. Okay, these high income earners. We've got a physician making $900,000, which equates to $75,000 a month. They've got a group plan that covers $10,000 a month, which is 13% of their income, keeping in mind that that group LTD is also taxable. Okay, we put an additional $10,000 a month of individual DI in place for them. So now we're up to 26%. That's still not enough, though. You know, when you think about it, he's only got $20,000 worth of coverage, and they're bringing home $75,000 a month. So Lloyd's throws another $25,000 a month in there. It's payable for out to 5 years on a monthly basis. And after 5 years, they are willing to offer a $4.5 million lump sum benefit to them. That is like having, basically in their world, after 5 years, they will pay a lump sum benefit in most scenarios. And that makes the policy equivalent to like an age 65 or an age 70 type of benefit period. So when we're talking about numbers, these are real numbers. And these policies come about. I know uh, when we were at the affiliate conference, Phil, we had talked about a case that we had run into last year. This particular, and it was a 3-mark case. This particular gentleman was the owner of 2 tech companies, and he was making $2.5 million a year. His income was, or his net income, or I should say, his net worth was so high that the traditional carriers could not take him. They were not allowed to by the reinsurance protocol. Lloyd's offered $135,000 a month of benefit and a $20 million lump sum benefit to him. The client went ahead and took the $135,000 a month for 5 years and a $10 million lump sum benefit. And that premium was $56,000 annually. That's not a bad payday. Speaking of paydays, let's talk about commissions for a brief second here because that's always important. Lloyd's commissions are structured a little bit different, but it's not bad. It's just different than what you'll see through traditional carriers. All right. Lloyd's pays a 15% first year commission on all of their products. Okay, that doesn't sound like a great deal. However, they pay 10% renewals each and every year that that policy stays in force, never to stop as long as the policy is active. So 10% renewals on these policies, especially these big ones, can turn into a nice book of business and pay some nice commissions over the long haul. So something to keep in mind there. So at the end of the day, what we were able to get was $45,000 a month or 60% of their benefit, plus that $4.5 million lump sum. Not a bad payday. Let's talk briefly Peterson versus IDU. All right. These two carriers, or I would say cover holders, I should say, they act like carriers, but technically they're cover holders. There's no love lost between these two. They don't like each other. They duke it out. And but I think competition makes everybody better. So it's not a bad thing. PIU again is the name brand. They are the Kleenex of the Lloyd's world when it comes to disability insurance through Lloyd's. But I will tell you that IDU has really become aggressive. They're making a lot of noise, and they know that they want to be a player. As we talked about, pricing is different on every case. And in some of these scenarios, we've seen 40% price difference. So we will shop this out for you to see, which carrier is going to be, or which of these cover holders, I should say, is the best option for you, and then bring that back to you. One of the things that they have to offer is guaranteed standard issue. I know we talked a little bit about this on the traditional carrier side. Here's where they're a little bit different. Again, this is going to be only GSI for them is guaranteed standard issue, and it only comes into play with 3 or more lives, which is fantastic, but it's going to be in that excess marketplace. Okay, so these are the high income earners, and we would stack on top of what they already have. They are willing to offer $100,000 a month or more with lump sum benefits of up to $10 million. And keep in mind, because it's guaranteed standard issue, we have no underwriting and we have no financials. They are guaranteed a policy, and it is super, super simple to obtain as long as we've got, again, has to be high income earners and three or more lives. But if you think about it, if you run into, as an example, you have a law firm, right? And you're helping out one of the attorneys there and they are making a substantial amount of money. Are they the only attorney in that firm that's making substantial money? Likely not, right? So instead of having, one high income earner as your client, what if we took them an offering for guaranteed issue in excess of what they already have? And now you've got, 10 or 12 that are all partners within these law firms. That's just one example of how that could work out for you. So
Todd,
think about how you can parlay that.
would that still be, because I know there's some GSI with domestic carriers, so you're talking coupling on top of, or would you go straight
Correct.
to Peterson?
Coupling on top of it. Yep.
Okay.
Yep. So after we've maxed out what we can do through the traditional carrier space and they need more,
Yep.
then we would take it to Lloyd's and get some offers on the table there.
Okay.
When I was there, we did a lot of that. We did tons and tons of it. And like I said, it can create some substantial income from a commission standpoint.
So just if I could, because I know some people on this call probably missed last week, present company included. When you say you saw a ton of those with like lawyers, so I could see a huge value proposition for DI for, doctors, dentists. What would be something that you would hear from to talk to a lawyer about DI and the value proposition of maxing out the coverage and
Hmm.
if you could, because those are some of the higher end sales. Um,
Yep.
I think what we want to make sure is that when we talk about stuff like this, we want to elevate the game. So I'd like to hear
Yep.
from my fellow bald friend here.
Absolutely. I would say, Phil, that second to physicians, attorneys understand disability the most.
Really?
Yep, yep, they get it. They understand it. They are running into clients many times that have had some sort of injury or illness or whatever, right? And so they see this stuff and they see how it affects people. And so they understand the need to protect themselves. There are law schools that are out there that do have, much like resident physician schools, they are out there talking to these people. So it is out there. In fact, we were just on the phone yesterday with an attorney in California. It was a 3 mark case, and this particular attorney was making $500,000 a year. We had the Lloyd's conversation, but she said, I think I can get by with what I got here for right now, but it's something to keep in the back of my mind. So again, it's about properly protecting them. During my time when I was at Peterson, what I found with the gigantic law firms that have, thousands of partners or hundreds of partners, across the world, is that if one of those law firms implemented a plan like Peterson for excess coverage and they're covering above and beyond what they can do, the next one would do the same, and the next one would do the same, and it was all playing keeping up with the Joneses. So it was a good snowball effect there. If you can literally touch base with one of them and have them understand why income protection is important if they don't already know, or to say, hey, listen, you've already got some coverage in place, but have you been maintaining it with your increased income over the years that you've been in practice? Or did you make partner and you just took a giant jump in income? Those sort of things. Being able to staff policies in there and help them out can take you a long, long way. So it's not about catching them necessarily while they're early. It's have they been maintaining pace with their income protection while their income has increased over the course of time, which is true for a vast majority of our clients that are out there.
So you're talking more lawyers who are like defense attorneys and in practice in civil suits,
Hmm.
things like that,
Yep.
versus some people that are on this call are like, well, I talk to estate attorneys. They probably aren't really focusing too much on stuff like that. But yes, I could see.
It doesn't make it any less important, but you
Right.
will find, there are attorneys out there that make 125,000. There are attorneys out there that make multiple millions of dollars. It depends upon, what their specialty happens to be. It doesn't mean that their um, whatever their income happens to be doesn't make them any less important than anybody else.
Yep.
And these people need to be properly protected. We may not have to take them to Lloyd's if they're making, 100 or $200,000 a year. If they're making
Yep.
five, $600,000 a year, we may need to take them there to get the proper protection that they need. So absolutely. And it doesn't just have to be them, again, talking with every client that's out there, if you can't afford to retire today, you probably should have your income properly protected. Let's switch sides of the house and we'll make this fairly quick here. I know we're getting a little short on time here. Again, Lloyd's will cover not only personal income protection, but they can do all of the business needs. All right. Business overhead expense. Well, as we talked about last week, why would Lloyd's need to talk about business overhead expense when every carrier offers a business overhead expense policy? Well, maybe they need more than what the traditional carriers can offer. Maybe they need $100,000 of coverage, and we can only get them to 50 with our traditional carriers. Maybe they have more than 10 full-time employees, right? Maybe they've got some medical history, right? These are all reasons that we can take them over to the Lloyd side of the house. Buy sell agreements. Again, same thing. All right. Medical impairments and excess is really where we see coverage being used there. Key person. Again, we don't have really very many carriers that are in that space. We are only, out of the 9 carriers that we are looking at, only one of the traditional carriers will offer key person insurance. So there's a limitation there. We can take them to Lloyd's in the event that they don't, that they would want to do that, or maybe it's just a better arrangement for them. You know what I mean? We would vet all of that out for you. And again, on the medical side, they also have loan indemnification. What I like about their loan indemnification is it does not have a business overhead expense requirement. We can get as much coverage for a loan as they potentially need. And again, if there's medical history there, that doesn't bother them. They will put an offer out on the table and make the proper exclusions for health history that happens to be there. So we can do loan policies. And what I would tell people when I was working there is their loan indemnification is literally like a snowflake. No two were ever built the same. They set up their loan indemnification policy to match whatever the loan parameters are to a T. So even if there's a balloon payment at the end, or they've got variable interest, so on and so forth, it will cover it as the loan is set up. So pretty nice opportunity there. One of the other things that they have is a contract guarantee. That's not something that traditional carriers have. So if we've got a contract between parties and there's money involved there, they can insure that contract. So that's pretty nice in the event that one of the people named in that contract would be too sick or hurt to go to work. So again, we have all of those opportunities that are out there. I'm going to switch gears and talk about some of the other things that they do. Okay, so everything we've talked about with Lloyd's up to this point in time has revolved around disability insurance. They do some other cool things. They offer a product called Failure to Survive. Now, again, we talked about how they were not able to offer life insurance. Well, they found a way. And they're not allowed to call it life insurance, so they had to come up with another catchy name for it. They refer to it as Failure to Survive. If you fail to survive, I guess you're no longer with us. So that's what they call that. Now, here's the stipulation, is that failure to survive has to revolve around a business purpose. Buy, sell, key person, loan indemnification, contract guarantees. Those are the things they're looking at. Here's where it gets really interesting. They will offer up to and north of $100 million worth of coverage. So we hear all the time, people are looking for jumbo policies, and I've heard numerous stories throughout my time where we had to pair together 17 carriers to get to this number, because they needed X amount of coverage. I could have done it with one carrier, and it would have been over with. No big deal. Here's the other part about this. Failure to Survive is set up to be paramed and fluid free. All right. It is a 72-hour approval process, and it's really, really ideal for impaired risk clients. It is an application, and that is it. All right. It is no more than 8 questions. We turned it into the cover holder, and within 72 hours, they say, Phil, you've got your policy, or hey, we're not interested in this particular risk. Again, this is Lloyd's, so very rarely do they say, sorry, we're not able to help you out. They will put an offer on the table. Underwriting is just a little bit different, okay? So it's underwritten more like a disability policy than it is a life insurance policy. So from an impaired risk standpoint, if you have medical history, instead of table rating or flat rating to get there, they will simply put an exclusion on the policy for that particular condition and then make the offer to you. So as an example, if I had a heart attack, all right, they would put a cardiovascular exclusion on my policy. If I die because of a cardiovascular issue, they're not paying that death claim. If I die for any reason outside of that, that is a paid claim. Again, not ideal,
Well,
but it's an offer.
real, real quick, Todd, because you're talking to a bunch of insurance people here, so my fear is everyone's going to go search through all their declines now and say, what'll Lloyd's take? So
Yeah,
um,
that's
before
fair.
it is, so from the context here, I also want to make sure is the gross worth of grief to go back through all your dead people and figure out who can get a coverage, you
The
know.
biggest thing is keeping in mind it has to revolve around that business purpose. Okay.
Okay. Yes.
Right. So there's the caveat. If we can't tie it back to a business purpose,
Okay.
now I will say that there were many, many times that we did circumvent that and we used key person insurance, right? They wanted a personal life insurance policy. They were the business owner. We just made it to be key person on themselves,
Yep. Because they are
right?
a key
They
person.
once it's paid out, they clean their hands of it. The company can do with it as they see fit. That wasn't our problem after it was said and done. Has to tie back to a business purpose though.
All right. So I'm a owner of Valor Financial Specialists. I'm not so light on my feet, right?
Yep.
So what
Yep.
type of exclusion would that be? Because I mean, you could you could pass from heart attack, cancer, like
Yep.
different parameters for a fat person.
Yeah. So
Well,
basically what they would do is you don't see it on the illustration, Phil, but they would build in additional premium based on height,
gotcha,
weight, right?
gotcha.
And that's all they're concerned about. So they're getting the extra premium for you. All right.
Okay.
The other thing to keep in mind with Fit to Survive is that it's typically set up on 1 year policy terms. All right.
Ah,
So it's a little bit like an ART. All right.
gotcha.
So something to keep in mind there. Here's another idea, sales idea here for you regarding failure to survive. If you have clients that are getting business loans, here's something to think about. A lot of times, what we find is they're getting their loans and failed to get their life insurance put in place so they can get their loan out of the financial institution. And they call and they go, well, Todd, I need to get my loan out, but I need to get that life insurance done. Let's get that done today so I get my money out later this week. That doesn't give me enough time for underwriting. Like this is crazy. Well, here's what we can do. We can put together a loan indemnification policy through Lloyd's. All right. We will have an answer for you in 72 hours. It'll satisfy the bank. You can get your money out. Now you can set up your traditional carrier policy, find the right fit for them, whatever it needs to be. Send it in, let them do their underwriting for 30, 60, 90 days, whatever it ends up taking. And once that traditional carrier policy is up and running, you terminate out the Lloyd's policy. All right. They pay as earned, so there's no chargebacks. All right.
Oh,
And they don't care about persistency. That doesn't bother them. So you can use it for as little as 30 days if you'd like. So again,
sweet
there's
mother of
all
God.
sorts of possibilities here. All sorts of possibilities.
Todd, where have you been?
I've been trying to preach this. Unfortunately, not everybody's been listening. So,
Oh my gosh.
but yeah. So again, we're not talking about disability insurance here. We're talking about business life insurance. They refer to it as failure to survive.
Well, those, I mean, you deal with mortgage lenders.
Yep.
That's like right there, because I literally 3 months ago had a case with a one of my agents where, we were harassing Banner to get an offer because they needed it like yesterday. And had I known that,
This is
shame on
this is a
me.
route to go, right? Now,
Heck
keep in
yeah.
mind too, because it's non-medical, because we're getting answers back, it's not necessarily cheap. They are paying for convenience.
Yep.
But again, if you need something fast or you can't get it at all, what other choice do you have? Right? They
Yep.
will put offers out there. So it is cool stuff. moving forward here to keep everybody on time, they do offer travel medical. All right. And what they offer is they actually have two different plans. They've got one for U.S. nationals that are traveling abroad, and they also have one for foreign nationals that are visiting the United States. One of the one of the things to think about, and one of the reasons that these policies get sold a lot, especially the one they call it U.S. away, that would be for U.S. nationals traveling abroad, is it does have an emergency evacuation benefit built into it. So in the event that something goes really wrong and you need to get back to the United States for care, that is a reimbursable benefit for you. What I like about travel medical is it is 100% online. All right. When you get set up with the cover holder from Lloyd's, you get dedicated links for these two products. You can apply them to your website. You can email them out to clients that you know are traveling, so on and so forth, or have people coming into the United States to visit them. The client does all of the work. And because it's a dedicated link, you don't even have to sign off on the policy. So if Phil's traveling out of country and he says, Todd, I need a medical policy while I'm over in Spain. No problem. Let me send you this link, you fill it out. Fills it out, hits submit, policy gets emailed right back to Phil, and I just got paid my commission.
I'm
Super
I'm actually
simple.
going to Mexico end of the month, so I might need that.
You can we can get you hooked up with that. That won't be a problem at all. Won't be a problem at all. Um, One thing I did not put on here, and before we talk about the last thing, so Phil, you had mentioned how do we get around the flat rating for pilots? One of the products that I didn't put on here is they do have an accident only policy, and we saw this numerous times also while I was there, where with the if the carrier was going to put a flat rating, and they can be expensive, they can be up to $7 or $10 a thousand. That adds up really really quick.
Oh yeah.
What we were having agents do was take the traditional carrier policy with a piloting exclusion,
Yep.
and then we put together an accident only policy for the same benefit amount to cover them while they're piloting only.
No kidding.
And it usually turns out to be they can do the piloting for accident only. Last time I talked to them about it, they were talking it was going to be somewhere between $1 and $2.50 per thousand.
Huh.
So that beats a $7 flat rate. I know that.
Oh, big time. I've seen a $20 flat one time. So
That's mega
yeah.
pricey.
Yeah. Yeah. No, that's amazing because
So something to think about.
I always talk about the exclusions, and it's like, some people are like, I'm not going to do this because I am a private pilot, and that's one of the things that I'm worried about. So,
Yep, yep,
yeah.
absolutely. So somebody on looks like on the chat was saying, is there a flyer or a website for this? Absolutely. The one I would have you check out is Peterson because they do all of the stuff that we're talking about here. Their website is piu.org. piu.org. And they've got all sorts of their marketing pieces are second to none. They have unbelievable marketing pieces that are available. Last thing that we'll talk about here briefly, and this will only take just a minute. People don't realize this, but they also have kidnap and ransom insurance. All right, so if it's ever in need, Phil's going to Mexico here at the end of the month. We may need to put a kidnap and ransom policy on him because we need him back in the
I
event
don't
that
know about
the cartel
that.
takes him. So it's really unique and it's fun. We didn't sell a ton of it, but it's available. And in the event that you need it, reach out and we can walk through how that all plays out. Okay, here's my contact information. Any other additional thoughts or questions that anybody has?
If
It's
anyone
cool
else on
stuff.
mute,
Sorry, Todd, I have one question.
Yeah.
On the pilot side, does it apply to if they only have private pilot licenses also?
So great question there. So the pilot specific insurance that Lloyd's offers would be for pilots that are flying for wage. If they have their private pilot's license and just fly on their own for fun, they would have a traditional carrier policy, and then they would either rate or exclude to include the piloting is how that works out if they're private piloting. So the coverage that we're talking about would be for for the pilots that are earning a living by
So
flying.
basically, what we're talking about is commercial pilots.
Commercial pilots or small private jet pilots
Yeah.
that are working for
Okay.
an organization. Hmm.
Gotcha. Okay.
So, any other questions that we got? Yes, other Phil Resch, you can definitely contact me. Or if you want to contact Todd, he's a
Yeah,
smart
reach out.
cookie. Um, Definitely write down the contact info. If you don't see it here, lose it. It's also on the 3Mark portal. And but yes, I'm readily available to talk to. We go through different process. The big thing is, and so I think just kind of talking about what Todd is Todd is a free resource for us. And I think a lot of people don't realize how many different utilities that you have in your tool belt. So you got a hammer, you got a saw, you got a screwdriver, whatever. And the idea is strategically partner the right way with the right people. And so if I recall, Todd, you are okay having conversations with customers too, correct?
100%. Absolutely.
So, so like in kind of putting a big ribbon over the idea of like disability insurance, especially like for those who came from prior organizations where they're telling you to have your clients cancel their DIs because you're getting living benefits. Not even close. Like that's it's an apple and an orange.
Yeah.
So there are different ways to diversify your practice where there's a need for different things. You just have to figure out how the dollars make sense and how it will strategically plan appropriately for a customer. Because you'll have some people say, well, I'll just insure myself to death at this point. To which I say we have a product for that. But what's the stats, Todd, on disability versus death, before retirement?
Yeah. You're 4 to 8 times more likely to become disabled prematurely than die prematurely,
Yep.
right?
So,
During your working years. It's just it's the way
yeah.
it's numbers. The numbers are the numbers. You can't debate them. So
What about
we are
anxiety?
here to help.
How do you
Yep.
claim like disability for anxiety or
Yep.
stuff like that, stress?
Mental, yeah, basically they lump all of that, Phil, into mental nervous disorders.
Yep.
So even as recent as 10 years ago, it was still pretty much a faux pas. If you were taking some sort of medication or had mental health history,
Yep.
you were an automatic decline.
Mm,
And so it shows that how the industry has changed. They are much more open now. And I can't make a blanket statement and say yes, we can cover them each and every time. It comes back to severity. It comes back to their particular situation, and it plays into the medical records, right?
yep.
Somebody who has situational depression is much different than somebody who has bipolar or schizophrenia. You know, um, you know, was it diagnosed 6 months ago, or what? Have you had this issue for 15 years and it's stable and well controlled? These
Yeah.
are all things that come into play. So it can range from in some scenarios where they just say, "Hey, we're cool. Whatever you need, we can get you through underwriting." Sometimes they will tell us we won't include any future increase options. More severe scenarios, they will limit the benefit period back to 5 years instead of offering an age 65 type of benefit period. And then there unfortunately are some where they just say, sorry, we can't help you, and they will decline. Again, when we run into those declines, that's where we go to our folks here at Lloyd's. All of the Lloyd's policies do have a mental nervous exclusion already built into them. So they're taking out a lot of subjective claims initially, which is why part of the reason that they can put so many offers out there. So if somebody does have some history there and we can't get them through a traditional carrier, I promise you we can get them through Lloyd's outlet. It's just that if they become disabled again because of those mental or nervous issues, that's not going to be a covered condition. That's a great question.
Yeah. So, I'll kind of put a bow on this because I know we're 3 minutes over, and I want to say thank you guys for staying longer if you're still here. Joking. But what I would say is that when you think about this, some of the highlights that I remember Todd mentioned before in prior trainings, especially the ones around, when you're positioning to a client, Mr. and Mrs. Client, you make 100 grand a year. Do you want option A, 100 grand, or option B, 98.5, but if you get, disabled and sick, we're going to give you 60% of your income tax free. Which one would you pick? And most people will pick, option B, majority would, because, you're taking 2, 3% of your take home income to give
Right.
you 60% potentially tax-free income in case you go down. And you're only as healthy as you are today. We don't know what tomorrow brings. But the main things that I would say is we don't just meet to meet, we meet to find opportunities. And so what I would encourage you guys is if you think about clients, the main things we need to focus on is name, date of birth, gender, occupation, okay? Salary, does that include commission and bonuses or just their
Commission
base?
and bonuses count. So as long as from a bonus standpoint, if those bonuses have been realized for at least 2 years, they would count them.
Yep.
Yep.
And then if they have any group disability or not, and I would say we're all private business owners. We all have our own organizations, LLCs, whatever. I would highly, highly recommend you get at least 3 people that you can take from an actionable step. Email Todd with the scenarios here, and let's see if we can get more acclimated with this additional value proposition and how it works. Again, the renewals are the big thing for this. You're talking what, 10 years at like 6% or
Yeah, at least
so
5% renewals mostly through 10 years. Absolutely.
so they pay a lot more lucrative from a referral base. And if you can tie it in to, again, create that holistic package of protect while you work and, retire the way you deserve to rather than the way the government tells you to, now you have that complete picture. And again, more tools in your toolbox is just always important. So,
Absolutely.
um, I want to thank you, Todd, for the time. I want to thank everybody again for staying in overtime. I'm going to post this up on the Valor website. So at Valor Financial. And that's a great point you put. Three Mark agents get a 10% discount on policies on themselves too. So this will all be up on the Valor website. Again, appreciate everybody. I will see you next week for the last training of the year. And then we will pick back up the 8th. I'm going to start my trainings for rookies. The 9th, which will be Thursday, will be the new set of trainings for every Thursday. Um, thank you guys so much. Thank you, Todd.
Absolutely.
Juliana, also a pleasure. Thanks for stopping by.
Thank you, guys.
All right. And you guys
Thank
Thank
you,
have a
you.
great
guys.
rest of your day.
Happy holidays.
Thank you.
Bye.
Bye.